So I think about infrastructure as being almost the skeleton of the economy. If we think about the arteries and veins as some of the roads, the bridges, the ports that help us get from where we're going every day. There's a lot of areas of the labor market where there's difficulty finding workers. And the tax cut is likely to increase the debt and deficit quite significantly. So there may be less additional space to invest in infrastructure, even though that's an area that you'd get more bang for the buck on. The wider deficit and the inflationary pressures are probably more likely to be driven by overall fiscal stance rather than the infrastructure piece. And so for US investors, they may actually want to play a closer eye on the progress of the infrastructure programs across big swaths of the emerging world. My name's Rachel Ziemba. I'm the founder of Ziemba Insights. I'm also a senior fellow at the Center for New American Security, a Washington-based think tank, where I focus on sanctions issues and trade policy. You've probably heard talk about One Belt, One Road, the China-led initiative to boost infrastructure throughout Eurasia. Just as an example of why this is so important, I spent some time in Turkmenistan 2 years ago, crossing the border from Uzbekistan to Turkmenistan. Not too many tourists go to Turkmenistan, but a lot of trucks do. They're making their way from China to Turkey and onward to Europe. And what happens there is you have truck drivers parked at the border all night for several miles, 5 or so miles into Uzbekistan, waiting to cross the border with very uncertain custom regulations and approaches, but also limitations on what's the weight capacity that some of the bridges on different sides of the border can bear. And so one of the possible investments in the Belt and Road Initiative is to not only improve the road capacity, but also to add and build out train lines, which might speed the process of customs and other regulations. Now, of course, the success of good roads and transportation aren't the whole story. The policies, the bureaucracy, the other steps in process are also important to reducing transaction costs. And that's going to be one of the things that determines which pathways goods are transported through, but also what companies and what countries companies want to relocate in. So I think about infrastructure as being almost the skeleton of the economy. If we think about the arteries and veins as some of the roads, the bridges, the ports that help us get from where we're going every day. But it's also important not to forget about social infrastructure, because you don't want to just build roads and bridges in areas where people might not live, or the people who live there might not be able to survive well. So social infrastructure, things like hospitals and healthcare networks, schools and other things that help people survive well in their communities. And in fact, anything that helps make a community more vibrant, I tend to think about as part of infrastructure. But we can look at countries, for example, like in Argentina right now, which has had decades of not investing in its physical infrastructure, the nuts and bolts of how we get from point A to point B, and about 50% of the cost of getting a piece of equipment or something you're buying from the producer to its end use, about 50% of that goes into the transport cost. And improving and reducing backlogs at the trade at those points would mean either that local and global consumers would see their money go further, but also that the net producer, the farmer, or the manufacturer would get more value for what they put in. Infrastructure feeds into economic output in several ways. A country with good infrastructure, for example, high quality of transport infrastructure, social infrastructure, health infrastructure, tends to not only have a better running, more predictable economy, which makes it easier for businesses to plan. It also reduces the risk of unanticipated costs. So, for example, if you're sending a shipment to a given country, are you going to have to worry that it's going to be stuck in customs for several weeks and maybe your produce is going to go bad in the prospect? It also can be, in the shorter term, it can be a driver of growth, because actually building the physical plant and equipment takes people to actually do the construction. It takes people to create the cement. It takes people to refine the steel and the pipelines. And so all of that can be, not only takes money, but it also adds jobs. And it depends by country how labor intensive it is. In richer countries where wage costs are higher, it's more likely that robots will probably be doing some of the construction along the supply chain. But there's still likely to be people actually doing a lot of the implementation. So it not only makes a country more attractive, but it also can help short-term investment. And so, again, in a country like Argentina, the infrastructure programs going on right now are a major driver of construction and a major driver of local growth. And one key question that's out there right now is concern about whether the infrastructure projects that are on train are going to justify the cost of the debt that's being issued to finance them. And that's an issue in Argentina, in places like Saudi Arabia, in many of the countries of the Belt and Road Initiative, and here in the United States, where the focus of the infrastructure bill that is wending its way through Congress as we speak assumes a high level of private investment in the projects, but also has some question marks about how much state and local governments will contribute to that. Now, how can you make sure there will be return on capital from these projects? One way would be to issue debt that is tied into the fees, say a toll road. So issue a bond that will be paid back with tolls over the next 10 or 15 years, so to tie it directly. Another way would be to accept costs throughout the supply chain. But it's something that a lot of investors, a lot of rating agencies are watching closely in the emerging world because there is that concern about debt. Here in the United States, the infrastructure plan might underwhelm some of the estimates, partly because we're already embarking on quite an expansionary fiscal policy at a strong point in the economic cycle, right? Growth is quite strong, unemployment is low. There's a lot of areas of the labor market where there's difficulty finding workers. And the tax cut is likely to increase the debt and deficit quite significantly. So there may be less additional space to invest in infrastructure, even though that's an area that you'd get more bang for the buck on. When we think about fiscal policy, government spending, we often talk about what are called fiscal multipliers. So if you spend $1 on whatever project, whether it's to build an infrastructure project, whether it's paying a public sector worker, anything the government spends money on, how does that feed into the economy? Now, typically, infrastructure projects have a fairly high multiplier, so you get out to the economy a higher amount. By contrast, military spending often has a somewhat lower, but not low, multiplier. And then across different countries, those multipliers can vary. So for example, in a country like China, which has already a lot of infrastructure and some good infrastructure in areas few people are living, the multipliers tend to be lower than in countries like Europe or the United States. So that's one thing that investors are taking a close look at. The other thing is that as we look out into 2019, 2020, we actually have an environment where more debt is being issued. not least out of the United States. And central banks are in tightening mode, or at least they're moving out of their super expansionary mode that was part of our evolution out of the Great Recession. And so we have a circumstance where there's more debt being issued. The central banks are no longer buying as much, and in some cases are selling. And so some of the infrastructure plans, if not properly managed, might add to that debt burden. Now, there's a number of safeguards, and I'm actually less concerned about infrastructure spending than some of the other spending, because infrastructure spending has a higher multiplier. It's more likely to impact positively the economy and help future growth. Because, once you've built a good road or bridge, assuming it's not going to fall apart next year, you get that benefit, you short-circuit traffic, you reduce transportation costs for many years. Nonetheless, we'll have people around the world looking closely at this. So here we are in 2018, and economic growth globally is looking pretty good. It's been strong across most parts of the global economy, the US, Europe, China, and if anything, even the parts of the global economy that were lagging, places like Brazil, places like the Middle East, they're starting to catch up. So things are looking pretty good. We're out of recessionary environments in almost everywhere in the world. But when we look ahead to next year, growth looks like it's slowing down. Some of that's natural. You can't keep growing at as fast a pace forever and ever, and growth's been above what we economists like to talk about as potential growth, which means that if you grow stronger than that level, you generate inflation. The pace of growth that we're experiencing right now is near to what we economists like to call potential growth. So growth above that pace would generate excess inflation. So we're looking now for drivers of growth that would allow us to increase that level of potential growth, to increase the quality of that growth. And one of those ways is by addressing infrastructure gaps. Infrastructure, roads, bridges, even social infrastructure like hospitals, schools, other things that would help key economies boost productivity. Now, around the world, we have sizable infrastructure gaps, including here in the United States, where there's been significant deferred maintenance and many roads, bridges, and infrastructure and ports that could use some work. If you're like me and you spend time commuting on the New York City subways, you know what I mean. So this is not only, and so addressing these issues, saving people time, reducing costs, they help us focus more on areas that add more value. And so, there's a number of key plans across the world to address this infrastructure gap. Infrastructure would be one of several drivers of fixed investment in capital goods, as opposed to just greater funds going to consumer goods, the things that we might buy and then use up and not use again. So where are the places with the big infrastructure plans? The biggest one out there right now is the Chinese-led infrastructure plan, known as One Belt, One Road, or the Belt and Road Initiative. Now, this is a plan uniting about 40 countries that is part of increasing supply chains, building, you may have heard it as the New Silk Road, but the idea here is roads, bridges, ports, trains to make it easier to transport goods, but also people across borders. Now, this started out as a Chinese initiative, and most of the companies involved here are Chinese so far, the contractors, but it really is involved in a whole range of countries. Other big plans announced, the Indians, large driver of global growth, global consumption, have plans to not only improve their infrastructure, but also make sure all houses have running water and electricity. This could be a major game changer. And here in the United States, we've had a number of attempts to launch a big infrastructure program. So the key question, though, is how big is this going to be? What's the impact? And how are we going to finance it? If we think about the amount of time and money that is lost because of public transportation delays in the tri-state area, in places like Washington, D.C., Amtrak delays and the like, that adds up to a sizable amount of money. We also, of course, know that in the New York area, there is still a lot of transportation infrastructure that hasn't been rebuilt and fully reinforced since Hurricane Sandy. And there are a number of urban areas and suburban areas that are really on a watch list. It's always hard to say what's a crisis and what's not. The proposed infrastructure bill would not necessarily prioritize areas that have the most need, but instead would prioritize areas where the private sector is more willing to invest, areas where they see a higher profit, either where they can charge greater fees, or maybe projects that they were already intending to do and they see an opportunity to get some government top-up. One thing that I'm watching closely is how the development of infrastructure bonds and other ways of financing these projects is materializing, and that's something that I think some investors will be targeting. I spend a lot of time in my work speaking to long-term investors, private equity firms, sovereign wealth funds, all of whom tend to have a sizable investment in real assets, including infrastructure. And the thing they often complain about is that they want to invest in infrastructure, but everyone is looking around at the same projects and that there aren't enough good projects. So one thing that entities like the World Bank's, International Finance Corporation and the like will probably be doing more work on is trying to focus more on how do we make these more investable over those time horizons. What should we expect from infrastructure over the next 12 to 24 months, sort of through 2018, 2019? Where will we be in early 2020? I would expect on a global level, we will see some pickup in infrastructure spending and generally fixed investment, but not as much as some people are hoping. And particularly here in the United States, I think that some of the results might be underwhelming. Firstly, because it's likely to take quite some time for current legislation to make its way through. Secondly, because the amount of government money to be allocated is likely to be fairly small, and the states and local authorities who are going to be expected to spend more to balance out the private sector investment, many of them are in some financial challenges themselves. And thirdly, just because of question marks about what's in the rules and the regulations, and that's going to take some time. So there will be an improvement, I would argue, from pace we've seen in 2015, 2016, even 2017. But it's probably going to underwhelm what the proponents are asking for. The outlook for 2018 is still quite good. My concerns in the U.S. and global economy are a little bit more for 2019 and 2020. That's when we'll start to see more of the impact from the central bank pullback, the end of quantitative easing, quantitative tightening, and some of the pressure on interest rates. We're also likely to see a new phase in the cycle where growth slows down a bit and the economy's not adding quite as many jobs. That's going to coincide with a time when China continues its slowdown in growth. China's been growing well above its potential. It's been putting half of its economy into fixed investment. That's not sustainable. But I think we're seeing a dynamic where after a year and a half of synchronized global expansion, we're likely to see a bit of a synchronized global slowdown. Doesn't mean a recession. That could happen, but it's not my base case. But I think we're going to see an environment where price pressures are ticking up a little bit. Nothing to be too concerned about, but economic growth is moderating a bit. And one of the key things I would watch, particularly here in the U.S., is the development, both on the supply and demand side of the energy industry. We haven't yet seen a big pickup in new investment there, but I expect with oil prices where they are, that there's going to be some more job gains in that area, and more investment in that area. In turn, if that doesn't happen, the U.S. consumer is likely to be battling with some higher oil and gas prices, and that might be a restraint on what's otherwise a strong economic outlook. Infrastructure affects all segments of the local and global economy. Because if infrastructure is not working well, there's a lot of waste, there's a lot of uncertainty. It's hard for investors to make, and even individuals to make decisions, going down to how much time do you allocate for your commute in the morning, because you're not sure if you're going to make it to your meetings or make it to work on time. So reducing some of that uncertainty can help individuals and businesses focus on other things and broader strategy. We're sitting here at a time where a lot of U.S. and global markets, particularly equity markets, are looking a bit expensive. Right, we've just had a correction in the equity markets that's largely been, that's taken equity valuations back to where they were at the end of last year. There's been a bit, we'll see over the coming months whether that's a blip or the start of renewed volatility. I think we're going to see some other sort of bouts of this over the course of the year. But how does the infrastructure story play into things that a whole range of investors, can take part in? The focus towards more fixed investment, including infrastructure, supports industrial and materials firms in listed equity. It also likely supports parts of the fixed income market because there will be more debt issued. But again, you want to take a look at whether the projects in the countries look like they're able to manage that. Here in the U.S., there's likely to be more infrastructure-targeted bonds that add to the dynamics of the muni bond markets. One of the biggest areas that's likely to provide support is actually to energy and metals producers. These are companies that have had a pretty good run over the last year as we've had the recovery and stabilization and then real growth as excess capacity started to be drawn down. We likely have more scope for a bit more catch-up for the actual equities and producers of these metals and energy, because these are companies that over the last several years had to make some major cuts, and they are only modestly adding new projects and new staff. So it's probably going to feed into higher profits over those dynamics. Now, infrastructure at a time when government spending is becoming a bit more expansive in a number of countries, not least the U.S., is likely to add to inflation. And so, and I've already mentioned that the metal and energy dynamic will be supported by these projects, and that's likely to mean that's one of many reasons why interest rates are going to be trending up over the next few years. It won't be linear. We won't see it going up a little bit every day, but there will be probably a jagged move upward. And so that also will put pressure on mortgage rates. It'll put pressure on borrowers of shorter term credit, particularly very high interest rates, credit card debt, and the like. And that's going to be likely to be one of the reasons that contributes to a bit of a slowdown in the economy. The same dynamics that were present at the end of last year, beginning of this year, around good economic growth, but inflation going back towards target, and equity valuations that are looking pricey. They're with us now, and they're likely to be with us even if the infrastructure plan manifests. Now, but I would be more concerned if I was a U.S. Investor about the dynamics of U.S. fiscal policy more generally, rather than just the infrastructure piece of the pie. And one of the concerns I have now is, now that Congress has gotten concerned about expansionary fiscal policy after the passage of the tax bill is that there may well be cuts to some of the more productive segments of government spending. Less money available for infrastructure, maybe cuts to healthcare and other sort of dynamics. And so the question mark about the greater issuance of debt and the wider deficit and the inflationary pressures are probably more likely to be driven by the overall fiscal stance rather than the infrastructure piece. And so for U.S. investors, they may actually want to play a closer eye on the progress of the infrastructure programs across big swaths of the emerging world, particularly the China-led investments throughout Eurasia, Argentina, the Middle East, and look at that sort of tracker. Why is that important? Because the companies listed on the S&P 500 in particular, they're global companies. Close to half of their revenues comes from global returns. And in an environment where the U.S. dollar is somewhat weaker than many of its peers, those international returns will look stronger in U.S. dollar terms. So, we've talked about, here today, infrastructure is likely to be a larger contributor to growth, but is maybe going to underwhelm as there's some greater challenges along the way and higher debt issuance. But I would really have a close look on demand and dynamics and trade in Asia. The other thing, I would have a closer look on trade policy, which is very much under review in the U.S. administration. And 2018, going into 2019, is the year that a lot of reviews that were launched in 2017, the government has to decide what to do about them. And so we're likely to see an environment where the input costs for infrastructure are likely to be rising and coming up. So we're likely to see additional increases in steel tariffs. We're likely to see greater uncertainty for businesses and producers in some of these key infrastructure supply chains to not know exactly what the costs, what the tariffs are, what the input costs are, and that might lead to some cost overruns in these projects. So those are some of the things I would be watching. The final thing I would watch would be around the reform of the foreign investment regulations into the United States. The body that decides that approves it, does security review is called CFIUS, and that's very much under review in Congress at this point. The United States historically has been very reluctant for foreign companies, particularly government-owned foreign companies, to invest in its infrastructure and to invest in sectors that are close to its infrastructure. And there obviously are security question marks there. But clarity on the rules of what's acceptable, what's not, makes it easier for investors and individuals, companies, to make their decisions. Uncertainty around it makes it very hard to develop a strategy. So those question marks about what the rules of the game are going to be for foreign investors, for American investors, that's going to be really important to the success of these projects and the overall economy.